Welcome back for part two on worker classification. So, a quick recap in part one. If you haven't listened to that, definitely go back and listen. First part of worker classification rules. In that part, I covered the three-part test for whether a worker should be classified as an independent contractor or an employee. And that test has to do with the common law control standard. In other words, we're looking at whether the employer has the right and the ability to control how that worker is performing the tasks that are assigned. The control over how the work is done or just control over what the output is. And those three categories of evidence were behavioral control, financial control, and business relationship. Part one is a discussion and breakdown of those three categories of evidence and how we got to that point. But in part two, we're going to look at some other types of specific worker arrangements that are defined actually in the Internal Revenue Code and how those specific types of arrangements should be treated for federal tax and especially employment tax purposes. And we're also going to look at what happens and what are some relief options for both employers and workers when a worker is not correctly classified. So let's start with some of these statutory approaches to specific kinds of workers. Now, in the first part, I mentioned two of the kinds of statutorily defined employees. The first one is corporate officers. Corporate officers are always employees by definition. That's very important for those of you either working with S corporations or those who own and operate S corporations. Because if you have decision making authority within that corporation, whether it's a C corporation or an S corporation, you are a corporate officer, and by definition, you are an employee of that corporation, and your compensation should be reported as if you're an employee. It's very important to keep in mind. The second type is a common law employee, and again, that's what we just discussed in part one and what I just briefly reviewed. So if a worker meets that common law control test of whether the employer has the right and ability to control the way that worker performs their duties, then that person is a common law employee of the employer. The third category here that we need to look at is what are considered and what are often called statutory employees. And these particular kinds of professions are interesting because by statute, they are treated almost as a sort of hybrid category. In some ways, they are treated as employees, and in other ways, they have some of the benefits of being treated as independent contractors. So the IRC lists workers in four specific occupational groups who, under certain circumstances, are considered employees for purposes of FICA tax, that's Social Security and Medicare, and then in some instances for FUTA or federal unemployment tax, but not for federal income tax withholding. And this is really key. So these individuals are employees essentially for employment tax purposes, but they are not for income tax purposes. So they may have the Social Security and Medicare tax withheld. Their employers may be responsible for unemployment tax. However, the employer is not responsible for withholding income tax. And that's actually that responsibility is going to fall squarely on the worker in order to account for federal income tax. So those four occupational groups are agent drivers or commission drivers, and those will have both FICA and FUTA withheld and paid by the employer. Full-time life insurance salespersons will only have FICA withheld, not unemployment tax. Then traveling or city salespersons will have both FICA and FUTA paid by the employer. And then home workers will have FICA only withheld. Individuals working in these occupations who are not corporate officers or common law employees are so-called statutory employees, and these come from IRC section 3121D3. Now, by agent drivers or commission drivers, we mean workers who distribute certain kinds of goods usually within a defined area. So that's going to be meat or meat products, vegetables or vegetable products, fruit or fruit products, bakery products, beverages other than milk, or laundry or dry cleaning services. Now, that is a fairly specific list of goods or services that driver is delivering for. But if you have a worker who is engaged in delivering any of those kinds of goods, then that individual needs to be treated as a statutory employee. That means the employer is withholding both FICA and paying FUTA, but then not withholding income tax. And the workers' W 2, all statutory employees are employees, so they do get W 2s, but that W 2 is going to indicate by checking the box in box 13 that that individual is a statutory employee. Now, I also mentioned home workers. Home workers here traditionally included, but wasn't limited to, workers who would make things like clothing, bedding, needlecraft products, or other similar sort of textile products at home. But now, today, it also can include workers who provide typing or transcribing services. So, when we say home workers, we don't mean any worker who's working from home, but there are certain types of professions that typically work from home that are considered home workers for the purposes of being defined as statutory employees. So if you have a client or you are working in a field that has to do with typing or transcribing, you're probably a statutory employee. Wages paid to agent drivers or commission drivers and traveling or city salespersons are subject to both FICA and FUTA withholding, but not federal income tax withholding. And then wages paid to full-time life insurance salespersons and home workers are only subject to FICA withholding. It's important to keep those in mind if you employ those workers or if you're working for employers of those professions. The statutory employee rules apply when a worker performs services for a business for compensation and meets the following requirements. First, the contract of service contemplates that the worker will personally perform substantially all the work. In other words, there's not going to be any delegation from that worker to anyone else. If the contract is written in such a way that the individual worker has either the ability or the right to delegate that work out to others, then that individual is not a statutory employee. That individual is actually an independent contractor. So if the contract's written in such a way that that individual will be the sole individual that is providing those services to that employer, then that individual may qualify as a statutory employee. Second, the worker has no substantial investment in facilities other than transportation facilities used in performing the work. In other words, notice that a lot of those statutory employee categories are based on delivery or driving around. So we're talking about salespeople, we're talking about drivers, delivery truck drivers. They are in general going to need transportation. That's going to be a critical component of their work. And so in those cases, they can own their own car, they can own their own delivery truck, but that has to be really the only substantial investment into the business. If they're investing into any other kind of property, plant, equipment in that business, then that individual probably will not qualify as a statutory employee. And then third, there is a continuing work relationship with the business for which the services are performed. This is not a one-off or occasional kind of arrangement. This is regular, steady work. Again, that goes back to the nature of employment. Employment doesn't have to be constant consistent work, but it is regular, recurring work that is part of a ongoing relationship between the employer and the worker. If that doesn't exist, then it's likely more of an independent contractor setup. That is from Treasury Regulation Section 31.3121D 1D42. Now, that's pretty deep into that regulation, but it's important to keep in mind that if you have a worker that meets or is in one of those four categories, or you have a client that is regularly working with individuals in one of those four categories, it's probably important to understand the statutory employee requirements and make sure that those are correctly applied and so that those workers are correctly categorized. Here's where the benefit, potential benefit to a worker who is classified as statutory employee can come in. A statutory employee includes payments reported on Form W-2 with box 15 checked. Excuse me, I think earlier I said box 13. It's actually box 15 where that statutory employee box is checked. On Schedule C, now this is what is different and can be a bit confusing the first time you see one of these W-2s. That W-2 is not reported as wages on page 1 of the Form 1040 like a normal W-2. Instead, those payments are reported on Schedule C, line 1, as gross income. And then the statutory employee can deduct related expenses on Schedule C. So these payments are reported on a W-2 as if the individual is an employee. There is going to be FICA and FUTA withholding, and those payments are reported on Schedule C. It's a bit of a weird treatment of that. If you are a tax professional, tax software usually has a fairly quick way to report this, and so again, it's important to check for whether that box 15 statutory employee is checked. If so, then you will get the benefit, that individual will get the benefit of both having an employment situation with their employer, but then also be able to deduct those expenses on Schedule C. Note that that is not available for regular employees or non-statutory employees. Ever since Tax Cuts and Jobs Act of 2017 was passed, we have not, for federal tax purposes at least, had employee business expenses deductible on Form 1040. Note that services provided as a statutory employee do not constitute the carrying on of a trade or business for purposes of the Self-Employment Contributions Act. So in other words, they are not subject to self-employment tax. Statutory employees are required to file a Schedule C for services performed as a statutory employee, separate from a Schedule C that reports net earnings from self-employment. So do not include the net income from the statutory employee activity in earnings from self-employment for purposes of calculating self-employment tax or any other part of the return that is going to draw on net earnings from self-employment, such as, for example, contributions to a retirement plan that is available to a self-employed person, such as a SEP IRA or a self-employed pension IRA or solo 401k or any other kind of retirement account like that. Except for full-time life insurance salespersons, statutory employees remain independent contractors for employee benefit purposes. In other words, statutory employees are not eligible for employee benefits that would be offered to non-statutory employees by the same employer. There is the one exception here for full-time life insurance salespersons. They are treated as employees not only for FICA tax purposes, but also for certain employee benefit programs maintained by the business. However, they can't base contributions to a self-employed retirement plan on the compensation received from the insurance business. This is one of those cases where tax law just kind of won't make sense. But think of it this way. You have the four different categories of statutory employees. Insurance salespersons are the one category that are eligible for certain employee benefit programs. Otherwise, other statutory employees are not. However, because those insurance salespersons are eligible for some of those employee benefits, they cannot base contributions to self-employed retirement plans on the compensation received from the insurance business. And there is one category here that is described in IRC section 3506 as a statutory non-employee. There are actually a couple other groups. This is the first one. So, a person who only connects sitters for either children, elderly, or the disabled with employers is not treated as the sitter's employer if they are compensated on a fee basis and do not handle wages. This is something that's fairly common is these essentially finders that will help connect sitters, so babysitters or individuals who will sit and stay with the elderly or the disabled. And these services will connect those sitters with the households and the families that need them. If that is all those services do, if all they do is make those connections and they collect a fee for making those connections, then by statute, they are not the employer of the sitters, and they are also not the employee of their clients. Instead, they act as an independent contractor with respect to both. Sitters are not employees of the placement services unless the placement service collects the fees and pays the sitters. In other words, they tend to operate as a third party that just merely connects the two. Now, the sitter can be a worker and therefore an employee or independent contractor of the client, the household or the taxpayer that needs the sitter. But that connecting service is just a third party to that arrangement, as long as the third party, the connector, is not the one that's actually paying wages out to the sitter. And then there's another category of statutory non-employees, two more categories. The first one is real estate agents, and the second is direct sellers. A qualified real estate agent and a direct seller are by definition not employees by statute. So a qualified real estate agent is any licensed salesperson whose pay is based on sales or output, not hours worked, and who has a written contract stating they are not an employee for federal tax purposes. This is a typical, in fact, this is almost a universal arrangement between real estate brokerages and the actual salespeople, the real estate agents. There's a contract between the brokerage and the agent that says that the agent is not an employee of the brokerage, and real estate agents tend to get paid at a commission, which is usually a percentage of the transactions that they facilitate. In those cases, by statute, that individual is not an employee and is an independent contractor. A direct seller is a person who sells or solicits consumer products for resale or outside a permanent retail establishment, or distributes newspapers, provided that their pay is based on sales or output and that they have a written contract stating they are not an employee for federal tax purposes. So it's a similar setup as real estate agents, only for consumer products for resale. And this comes from IRC section 3508. So we get the statutory non-employees from IRC section 3506 for those sitters and IRC section 3508 for real estate agents and direct sellers. Those are the three categories of statutory non-employees. And then you combine that with statutory employees, common law employees, and then corporate officers. And those are really the four main categories of workers that are described in the Internal Revenue Code. Essentially, if you have a worker who does not meet one of those three criteria, either a corporate officer, a statutory employee, or a common law employee, then that individual is likely an independent contractor. However, we're going to have to look at, anytime we have a relationship between an employer and a worker, we're going to have to look at that common law control test to determine whether the employer has the right and or the ability to control the way that worker is working. And if so, we're probably going to lean toward classifying that worker as an employee. Otherwise, if the employer is not uh, exercising that control, and the way the agreement between the employer and the worker reads really doesn't give the employer the right to control the way that worker does their work, in that case, we're pretty safe sticking with an independent contractor arrangement. Now, there are situations where you could have a worker operating as both an employee and an independent contractor. So a worker can perform services for a single business in two or more capacities. It's possible that in one capacity, the worker should be classified as an employee, but in another as an independent contractor. So, for example, a corporate director in that capacity is not considered an employee of the corporation for those services, even if that worker also serves as an employee or officer of the corporation for other services. You can imagine a corporate officer who also sits on the board of directors. In fact, this is fairly common for a lot of companies, especially smaller family held companies. That individual may serve in both roles as both a corporate officer as well as a corporate director. If their service in the way of being a director rises to the level of deserving compensation for that work, in other words, there are regular board meetings, that individual spending a significant amount of time doing director work, then that individual might be compensated as a non-employee, as an independent contractor, as a director, but then also be compensated as an employee, as a corporate officer. And that actually comes from Revenue Ruling 58505, which it really discusses this potential for a dual status of a worker for these split duties. What this revenue ruling actually focused on was a situation where certain individuals worked as both corporate officers and as independent sales agents, insurance sales agents in an insurance company. So they worked independently selling policies, but they also provided the administrative services that it took to actually run the company. So the IRS in this revenue ruling determined that they were both employees for federal employment tax purposes with respect to duties performed as officers of the company, but then they were not employees for purposes with respect to their insurance sales activity. So again, it's entirely possible that an employee, a worker, is providing services to the same employer where one set of services would lead to classification as an employee, another set of services would lead to classification as a non-employee, as an independent contractor, and it is possible to do both. I have seen questions asked of other by other tax professionals where they have a taxpayer that received both a W-2 and a 1099 NEC for non-employee compensation from the same entity. Sometimes that might be an error. Sometimes that might be a reporting error. Sometimes that could reflect that that individual worked for a brief time as an independent contractor. And then because the employer was satisfied with the work or just the nature of the relationship changed, that individual was brought on as an employee. And so some of that compensation truly was paid to an independent contractor. And at some point, that relationship was changed by the two parties to where now that individual is an employee. And then there are situations like this dual status, where at the same time, that individual is earning compensation both as an employee and as an independent contractor. Those questions that I see will often, end with something like, can this be correct? Can it be correct that a single individual is getting both a 1099 NEC and a W-2 from the same entity, from the same employer? And in that case, I would ask for more information. I would ask, well, what is the nature of the payments that produced the 1099 NEC versus the W-2? Why did the employer report two different sets of compensation for the same worker? It's entirely possible that worker uh, got compensation of two different kinds with respect to employment tax. Now, it's also possible that that was erroneous and should have been fixed. I've seen cases where the worker did not have the necessary paperwork to the employer in time to be on payroll when that worker had already been working for the employer. I've also seen misclassifications where the employer just didn't know that they actually needed to treat that worker as an employee. And after a little bit of time, either the bookkeeper or the tax advisor or someone raised the point that, hey, I noticed you're making payments to this individual. What is this individual doing? What is this individual providing for your business? Oh, that sounds more like employment than an independent contractor setup. And if you can't tell, I've been in the position where I'm the one having to have this conversation with a client. So it's possible that you have a situation where some payments were made to a worker where that worker should have been classified as an employee. However, for whatever reason, wasn't until later in the year when that worker was then compensated as an employee. In other words, their payments were run through payroll. In those cases, ideally, you would have all of those payments if there was no change in the actual relationship between the worker and the employer. Ideally, you would have all of the payments reported through payroll. However, sometimes you get a worker that just isn't added to payroll until later, until after some of those payments have made. And maybe in those cases, you get both payments that are reported as wages and payments that are reported as non-employee compensation. It's unfortunate that that happens sometimes, but it's inevitable. And so in those cases, we just have to go to the taxpayer, go to the client, and then ask for a little bit of clarification of what actually happened. And if there's something that needs to be fixed, if we have a situation where a worker truly was misclassified, then we would need to discuss what the employer or maybe the worker need to do in those situations. And that brings us to the next section of this episode, which is looking at relief for misclassified workers. Now, there are certain kinds of relief that are available for both employers and employees. But first of all, let's look at what the actual rules here are as far as the responsibility to correctly classify a worker. Whose job is it to make sure that a worker is correctly classified? Well, it's actually the employer's. And there's nothing in the code that specifically says that an employer is responsible for correctly classifying that worker. However, we get there indirectly by way of looking at the sections of the Internal Revenue Code that deal with employment taxes. So an employer must withhold and pay employee federal income tax withholding, employee FICA withholding, and employer FICA. Those come from IRC sections 3402, 3101, and 3111, respectively. So 3402 is employee income tax withholding, 3101 is FICA withholding, and then 3111 is the employer FICA. An employer must hold the amounts withheld from employee pay in a special fund in trust for the United States, subject to significant penalties if unpaid. That's IRC section 7501. So what we get from combining these sections together is that the employer is responsible for correctly identifying payments to a worker as wages and therefore correctly withholding and paying employment taxes based on those wages. And if that isn't done, if the employer does not withhold and pay those employment taxes, then the employer is the one who is responsible and penalized. Now, in Section 3402D of the IRC, we get that if an employer fails to withhold employment taxes from an employee's pay, then it will not have to pay that specific amount of unwithheld tax, provided the employee eventually pays the tax. So, what does this mean? Because remember, Section 3402 refers back to federal income tax withholding. In other words, if an employer failed to withhold federal income tax from one of its employees' wages, and that employee subsequently wound up paying the income tax due, then the employer is off the hook, essentially. Um, Now, this doesn't always apply, and I'll talk about some cases here in a minute where this doesn't apply. But if the employer fails to withhold income tax and the employee subsequently winds up paying the tax anyway, then the employer is essentially off the hook. If the employee never pays the tax, though, then 3402D doesn't really apply because the tax hasn't been paid yet. And in that case, we might have a situation where the employer is actually still on the hook. If an employer misclassifies a worker, then there are some options here for statutory relief. So, an employer is generally liable for the Social Security, Medicare, and the withheld income tax if it incorrectly treats an employee as a non employee. However, IRC Section 3509 applies if the employer treated a worker as a non employee and did not intentionally disregard its responsibility to withhold employment taxes from employee pay. Section 3509 gives some relief to employers, but only in the case where they did not intentionally disregard the responsibility to withhold employment taxes. In other words, if it was an honest mistake, if the employer misclassified the worker but did not truly intend to disregard its responsibility to correctly classify workers as employees and therefore withhold and pay employment taxes for that employee, then Section 3509 applies. In the case where this is true, where the employer did not intentionally misclassify and fail to withhold employment taxes, then the employer has to pay the following: 1.5% of wages paid as federal income tax withholding, and 20% of wages paid as employee FICA withholding, 20% of the amount that should have been withheld from employee wages. These are significantly reduced amounts from what the employer would have had to withhold and therefore pay in. Now, this assumes that the employer correctly reported those payments to that worker on Form 1099, assuming that the employer also did not intentionally disregard its responsibility to correctly classify that worker. So let's assume for the moment that the employer just didn't know better and thought that worker truly was an independent contractor. Then the employer still has a Form 1099 filing requirement for the payments that it made to that worker. If that employer fails to file Form 1099, then those payments double. It becomes 3% of wages paid and 40 for federal income tax withholding, and then 40% of its responsibility for FICA withholding. That all comes from IRC Section 3509A. 3509A is, and really the whole section, 3509, is important to understand if you're working with an employer that is on the verge of realizing that it has misclassified some workers. That determination of the liability under Section 3509 has no effect on paid taxes, though. So if Section 3509 applies, then the following is true. First, the employee remains responsible for any tax assessed or collected. This is only relief for the employer. We're not looking at the employee here under Section 3509. The employer can't recover any unwithheld tax from the employee. And sections 3402D, which I just read before, that any tax paid by the employee, the employer is no longer responsible for, at least in terms of federal income tax withholding. Those do not apply. And then also Section 6521 does not apply. So Section 6521 overrides the statute of limitations if a refund of either self-employment or payroll tax is barred but could be credited toward a liability of the other in case of an erroneous payment. In other words, you have a worker that you have misclassified as an independent contractor. That independent contractor has correctly reported from their perspective the income as self-employment income and paid self-employment tax on those net earnings from self-employment. What 6521 does is allow for the payments of self-employment tax to be credited toward a liability of payroll tax, even if the statute of limitations has passed for a refund of that self-employment tax. That's the only time it's triggered, though. If the statute of limitations hasn't been passed yet, then we don't need 6521. That refund and then application could just happen anyway. But if we're outside of the statute of limitations, then we need some mechanism to apply the erroneous either self-employment or payroll tax payment toward the correct one. That does not apply in a case where we have a determination of an employer liability under Section 3509. There's a tax court case, Mescalero Apache Tribe v. Commissioner, 148, Tax Court 11 from 2017, where the tax court held that the disclosure of third-party taxpayer return information to absolve an employer of a Section 3402A tax liability was not barred. Therefore, an employer can access IRS records to determine if its workers paid taxes on income reported via Form 1099. So that's what we're getting at here under Section 3509, is we're essentially trying to make the IRS whole. We are looking at what the liability would have been had the employer correctly classified workers as employees and therefore withheld and paid employment taxes. We're looking at what actually happened with misclassified workers as independent contractors and what they paid in as self-employment tax and their own income tax. And we're essentially looking at the difference. And if the employer is trying to make a case for the fact that its workers as independent contractors actually paid the taxes that they should have, then that's essentially a way for the employer to get itself off the hook. But the only way it would know that is if it had access to the IRS's records, or if its workers just freely admitted that they paid taxes. But really, the best way for the employer to confirm that is looking at IRS records. However, there are privacy concerns, and the IRS is not able to disclose taxpayer information to a third party, even if that third party is an employer in this case. But the tax court are determined that this essentially puts employers at a disadvantage. And so the IRS is required now under this tax court decision to disclose that necessary information to employers in these kinds of determination cases. Back to Section 3509 relief. Again, intentional disregard to correctly classify a worker and therefore withhold and pay employment taxes nixes any kind of statutory relief. Reduced rates under Section 3509 don't apply if the employer intentionally disregarded withholding, if the employer withheld federal income tax but not FICA taxes, or if the worker is a statutory employee. So this is another reason why it's important to correctly classify those employees. If they are statutory employees, Section 3509 doesn't count. If the employer withheld income tax but not FICA tax, 3509 doesn't count. And then if the employer intentionally disregarded withholding entirely, Section 3509 doesn't count. So note that intentional disregard is different from, but might be related to, willful failure to collect, account for, and pay payroll tax, which would result in a trust fund penalty under Section 6672. It's a separate but related determination of that trust fund penalty, whether that employer intentionally disregarded its requirement to withhold and pay taxes and therefore qualify for relief under Section 3509. There's also Section 530 relief. Now, this is not Section 530 of the Internal Revenue Code. This is actually Section 530 of the Revenue Act of 1978. This provides relief that terminates a taxpayer's employment tax liability with respect to an individual not treated as an employee, so an individual whose payments were reported as an independent contractor, if the following statutory requirements are met: a reporting consistency, a substantive consistency, and reasonable basis. The reporting consistency means that the taxpayer must have timely filed the requisite information returns consistent with the treatment of the worker as a non-employee. In other words, it had to file the 1099s. Substantive consistency means that the taxpayer or predecessor treated the worker or any worker holding a substantially similar position as an employee. This is a facts and circumstances determination, but we've got to look at the employer and see if there are any similar roles within that organization. And if we see an inconsistent treatment of workers with similar jobs and job descriptions and duty assignments, if one is being treated as an independent contractor and the other one is being treated as an employee, then that's going to disqualify that employer from Section 530 relief. And that's going to depend on a review of actual day-to-day services performed and a comparison of the job functions, not just looking at the similarity of job titles or categories. And then finally, reasonable basis. The taxpayer has to have reasonably relied on either a prior audit determination, some judicial precedent, or standard industry practice when that employer classified that worker incorrectly. For reporting consistency, in other words, the taxpayer must have filed 1099s. That's only true if the nature of the work and the employer means that that a 1099 was appropriate. So, for example, if we're looking at a worker who thought that the worker truly was a volunteer, for example, then no information returns would have been required. So there are some exceptions, but they're limited. And in general, if you have a worker that is providing work to the point of getting some form of compensation and therefore being incorrectly classified, then it's going to be a tough case to say that that worker should not have gotten a 1099 reporting. So in other words, we're looking for, were 1099s filed, Is that consistently applied across similar workers in that organization? And then does that employer have a reasonable basis for making that worker classification? And then on the worker side, there are some ways that the worker can try to get some relief. Because keep in mind, if a worker is misclassified, then that worker is now on the hook for not only income tax, but also self employment tax as well on those net earnings from self employment. So that worker might be able to deduct some ordinary and necessary expenses in the way of earning that self employment income. But that doesn't necessarily mean that worker is better off than they would have been with an employer paying half of the FICA along with withholding federal income tax. So you can imagine some situations where this worker might have not had significant deductible expenses, and therefore the cost of not only both halves of self employment tax, both the employer and the employee half of employment tax, but then also the income tax and any late payment penalties and underpayment penalties that might be assessed on a balance due resulting from that self employment income, that worker might be at a disadvantage by going along with being classified as an independent contractor. In those cases, a misclassified worker can file Form 8919, uncollected Social Security and Medicare tax on wages. Now, this will help with FICA tax. It won't do anything about income tax, but the worker can use Form 8919 to calculate and report his or her share of uncollected Social Security and Medicare taxes due on his or her wages. Now, by using Form 8919, the employee's Social Security and Medicare taxes will be credited to the employee's Social Security record. So that can help the employee, but it might also trigger an issue with the employer. So the worker has to be careful, essentially, about using this form, which might result in a decision not to file it in the first place. And I've actually been involved in situations where I thought my client really should have been treated as an employee instead of an independent contractor. I told them about that, and they were perfectly fine going along with the status quo. Uh, in those cases, I didn't push, I didn't insist. I just did what I thought was my due diligence and my ethical responsibility at the time of informing my client that I think there is a worker classification issue here. If you agree, then here is what I recommend doing to address it. However, it's ultimately the taxpayer's decision whether to agree that there is a classification issue and what to do about it. For Form 8919, the taxpayer is going to select one of four reason codes. A is that I, the taxpayer, filed Form SS8 and received a determination letter stating that I am an employee of this firm. So, Form SS8, I'll talk about here in a minute. Code C is that I received other correspondence from the IRS that I am an employee. Code G is that I filed Form SS8 with the IRS and haven't received a reply yet. And then code H is that I received a Form W2 and a Form 1099 miscellaneous or NEC from this firm for 2025, and the amount on Form 1099 miscellaneous or NEC should have been included as wages on Form W2. In this case, the instructions for Form 8919 say not to file Form SS8 if you select that code H, because the employer providing both a W-2 and a 1099 indicates that that worker probably should have been a W-2 employee all along, although, as discussed earlier, that may not exactly be the case. Now, if none of the reason codes apply, then the taxpayer should use reason code G and file the Form SS8 as soon as possible by the date the tax return is filed. Now, Form SS8 is essentially going back through those three categories of evidence from the common law control standard and applying them to the taxpayer's specific facts and circumstances. So, Form SS8, determination of worker status for purposes of federal employment taxes and income tax withholding, applies those three categories of evidence and essentially is a questionnaire that either the firm or the worker can fill out and file with IRS. The firm might use this as a way of trying to show that the worker was actually correctly classified as a contractor, and the worker might use SS8 to try to get the IRS to convince the employer that the worker should be classified as an employee. When either side files Form SS8, then the IRS might disclose the information provided to the firm, to the worker, or if there is a third party that is handling the payment of the payments to the worker, then IRS can disclose and involve that payer as well. In order to assist in the determination process. Now, the first step of that process is for the IRS to acknowledge receipt of Form SS8. So this will look like a letter coming back to the taxpayer who filed it. The second step is the IRS attempts to get information from all the parties involved by sending those parties blank Forms SS8 for completion. This will essentially give the other side in this a chance to answer and describe the nature of the working relationship from their perspective. So if the worker files Form SS8, and IRS acknowledges receipt of that, then IRS will send a blank Form SS8 to the firm, to the employer, and let the employer fill that out and respond. And at that point, a technician is going to review the facts and the Forms SS8, apply the law, and then render a decision. Now, that decision can either be a binding determination that is in the form of a letter to the parties, or it can be a non binding advisory information letter. And that's just going to depend on the technician and what the technician is able to determine based on the facts and circumstances and the evidence presented by both sides. Now, that determination does not constitute an examination of any federal tax return. This is all done separately. This is not done along with filing a tax return. So, from the IRS's perspective, this is a completely separate matter from any federal tax return. So, taxpayers do not have the same appeal rights for this determination as they would, for example, with an examination of a federal income tax return. However, a taxpayer can submit additional information, maybe something that they remembered or something that wasn't brought up initially with the SS8, and request a reconsideration of the determination. But at that point, it's going to be up to the technician in the IRS whether to reconsider, and if so, if there's any change in the determination. Okay, that's a lot for this episode, but essentially it comes down to a few key takeaways here. So, certain workers are classified by statute as employees. I mentioned corporate officers at the end of part one. And then in this episode, we've got those statutory employees, those four categories of statutory employees. And then we've also got some statutory non employees that we need to keep in mind. But for those statutory employees, they actually retain some characteristics of independent contractors. And those statutory employees have unique reporting requirements that include both FICA withholding and Schedule C reporting. Employers, though, are ultimately the ones responsible for correctly classifying workers. And it's the employers that will face penalties for not correctly classifying workers and therefore not reporting and withholding employment taxes. If an employer is confused or not sure of how to classify a worker, then it should at minimum file forms 1099 to report the payments made to that worker And really, the safest way to approach this is to use Form SS8 to request a determination by the IRS. If all of that either doesn't happen, or if it does happen, but now the worker has been classified as or should has been determined to be an employee, then there are some avenues for relief for employers. And both employers and workers can request that determination of status from IRS. So in cases where it's just not clear, it might be best for the employer and the worker to agree to request that determination from IRS. So if you found value in this episode, please let me know by liking and leaving a comment in your podcast application of choice or on YouTube, wherever you're watching or listening to this. And then for the next episode, we are going to dig into what has been over the last several years one of the most interesting and a relatively complex addition to tax law, and that is the qualified business income deduction. Thanks.